Hello, this is Anthony and welcome to On the Ladder with Anthony, the channel dedicated to helping first-time buyers go from dreaming about property to actually owning your first property. So in this video, it's more of an educational series where I want to help you understand interest rates, especially where they pertain to mortgages and the difference between the two. So when you're purchasing a property, there's really two different mortgage products to choose from an interest rate perspective, and these are fixed versus variable rate mortgages. So if you're ever looking at mortgage products and just having a look around, you typically see a fixed rate mortgage. They're typically offered in two durations, so 2-year fixed, 5-year fixed. Some lenders go a bit longer. I've heard of 10-year fixes before. And what these basically do is the interest rate you're charged on the mortgage product. So let's say if your interest rate is 4.5%, that will be fixed for a number of years as determined by the fixed rate product. So if it's a 5-year fix, the interest rate on that mortgage will be fixed for 5 years. If it's a 2-year fix, the interest rate will be fixed for 2 years. So if you have a 4.5% interest on your mortgage product, and let's just say this means your mortgage payments are £1,000 a month, that means your mortgage payments will stay at £1,000 per month until the end of a fixed rate period. At the end of a fixed rate period, you go on something called the SVR, the standard variable rate, which is a rate that the banks set individually based on some kind of baseline. It could be an individual within the bank baseline, or it may track the Bank of England interest base rate. But to just simplify things, a fixed mortgage means your interest rate and your monthly mortgage payments are fixed for a particular period of time. Then after that time, it reverts to a standard variable rate, which is a variable rate mortgage where your interest rate and payments could change each month. It could go up if the tracking rate goes up, or lower if the tracking rate is lower. But typically these mortgage products are a lot higher in terms of rate and payment than fixed rate products. And also I should mention that even if you have a fixed rate product, at the end of a fixed rate, you can always just do another fixed rate. So if you've got a 5-year fixed rate and your 5 years come to an end, you can just fix again for another 5 years. So it's not like you go on one 5-year or 2-year fix and that's it, you're done. You're on the standard variable rate forever. No. You fix for a certain period of time. When that finishes, you fix again. And then when that finishes, you fix again until your mortgage term comes to an end. The second type of mortgage interest rate products are variable rate products, typically called tracker mortgages. They're called tracker mortgages because they typically track a baseline interest rate. So if the baseline interest rate is a Bank of England base rate, which is the rate of interest the central bank in the UK sets, then the mortgage offered by your lender will likely to be a percentage point or so above the base rate. Maybe more than a percentage point, but the general gist is a tracker rate will track some kind of baseline rate as your mortgage product. It doesn't have to be the Bank of England base rate. The banks might have their own internal baseline rate that the tracker mortgage basically tracks and will vary each month based on that base rate. So you might be wondering, Anthony, well, what should I do? What kind of mortgages should I be looking at? My advice to all first-time buyers is all the same. When you are taking out a mortgage product, always fix your rate, because you do not want to get caught offside. Do you know how many people were caught offside during 2022 and 2023 after lockdowns were lifted and interest rates started to skyrocket because inflation was getting out of control globally? There were people paying £500 a month on their mortgage, but were on variable rate mortgages that went up to £2,000, £3,000, £4,000 per month. Imagine that. Imagine you are used to paying £500 a month for your mortgage, and then the next month it just jumps to £750, then £1,000, then £2,000, and before you look at £3,000. How can you afford that if your income is maybe £2,000, £3,000 a month? So don't get caught offside like that. And so many people were caught offside during 2022 and 2023 because of advice from brokers or whoever that rates are always going to be low forever, so just stay on the variable, we don't need to fix. Because fixed rates are typically higher than tracker mortgage variable rates. So people are saying, just use a tracker mortgage, it's cheaper, don't go on fix is more expensive, rates are going to stay at 0 to 0.5% forever. How wrong they are. So my advice to any first-time buyer is, when you are purchasing a property, always fix your rate so you have certainty around your monthly payments. Yes, the fixed rate might be slightly higher than the tracker rates. And yes, there are people out there saying, yeah, interest rates are coming down. Bank of England may be doing 2, 3, 4, 5 interest rate reductions this year. Fine, but who knows? Inflation could ramp back up again and Bank of England may do an interest rate increase than an interest rate decrease. The rule of law when it comes to economics is this: nobody knows anything. We're all speculating about what may or may not happen and what the Bank of England may or may not do. The advice I'll give you as a first-time buyer is never be a gambler, because gamblers always lose. So never gamble on where the economy is going, what's going to happen to rates. And yes, there's lots of talking heads on the TV who talk very convincingly, like they know what's going to happen. But let me tell you this: if they were so clever, they'll be trillionaires, because they would know how everything in the world works. But it doesn't really work like that. And you know what? If someone has an opinion and they're wrong, nothing happens. So don't let somebody talk confidently lead you into making silly decisions. I always advise first-time buyers, fix, so that once you fix your rate, you just have that peace of mind. Because all those fixed rate mortgage people during 2022, 2023, when rates were going up every single month, they were chilled, because even though rates was going up to 8, 9%, all these craziness with these standard variable rates, they were still on their fixed to 3%, perfectly fine. And the people who fixed from 2020 were refinancing or having to refinance now in 2025, who done 5-year fixes, when rates came down from the craziness we saw in 22, 23, 24. So my advice to you is always go for the fixed rate product and do not chance the tracker / variable rate products, because nobody knows what's going to happen to the economy. So give yourself that peace of mind and cost certainty than getting caught offside and being in a position where your mortgage payments are increasing every single month. I hope you found significant value from that, because this is unconventional advice that most people are not going to give you. If you implement this, you'll be thanking me later, because a lot of people that I was saying, fix your mortgage now, do not chance the variable rate, thanked me immensely during those rapid increases that we saw recently. Again, hope you found value from that. And if you did, and you want to find out more and engage with a community and actually start your journey of getting on the property ladder, please join my WAP community in the link below. You get 24/7 access to me. You get all my resources, knowledge, and insights that I share within the community to help you make an informed decision to become a first-time buyer. Thanks for tuning in, and I hope to see you in many more videos in the future. Take care.